Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 1st of August. I'm Daniel Lam, your host for the podcast. Last Tuesday, I attended the flag ceremony for the Hong Kong-China athletes for the upcoming Hangzhou Asian Games in September. Well, you may not know this, but the games were meant to be held in September 2022, but they got postponed by 12 months. Now, naturally, I was very honored to be the leading player in the Hong Kong-China chess team, but at the same time, I was feeling sad for those who made the team in the qualification tournament last year, but did not make it for this year. It really was an extreme illustration of the expression, there's a time for everything. Now, lately, many of those who have taken an interest in Hong Kong-China equities must have been wondering for the entire year so far that when is the time for Hong Kong-China equities to rally. Well, after being the worst performing major market globally year to date, there have been recently signs of life, as we have noted in our podcast last Wednesday. Over the past 5 sessions, the turnover in Hong Kong-China equities has been twice the average turnover over the last few months, showing good support and buying interest. The shift from extreme optimism in the first quarter this year to extreme pessimism in China today now appears to be complete. As we noted in the podcast last week, investors have been positive on the acknowledgement from the Politburo about the challenges that the Chinese economy is facing, and the signaling from policymakers that they may adopt a more pro-growth stance in the second half of the year, including new measures to support growth in the private sector. Now, liquidity seems to be abundant, so the heavy lifting would most likely be coming from fiscal stimulus in order to address weak consumer confidence and insufficient domestic demand. Now, it is likely to be targeted at the high-growth industries in the private sector, where the economic spillover from hiring to consumer spending could provide a floor for consumer sentiment. We've been reiterating our view that Chinese equities have the appearance of a high convexity trade, i.e. limited downside, with reasonable upside potential. Technically, the first level of support for the Hang Seng Index is the lower end of the recent gap at 19,941, followed by 19,400, which is the top of the downward channel of the index that has been in place since April this year. These two are good levels for investors to consider buying Hong Kong-China equities. Consumer discretionary and communication services remain our top 2 sectors in China. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.